this was so good. There was so much value brought on this podcast. I don't know if we can let guests back any longer. I don't know if guests are going to be allowed anymore. This was too good. Hello, everybody. It's Jake and Gino, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Mr. Stenziano, I'm doing great today. How you doing, bro?
Doing awesome, because we have a special edition of the Wheelbarrow Profits Podcast. That means it's only Jake and the G-Daddy bringing the Panya today. Interesting little thing we got going on. We're going to talk about how to vet a deal. Okay, we want to know how to invest passively and how to vet a deal. A lot of people out there may be working, maybe busting their butt really hard and not have time to just start investing on their own. A great way to start is to go out and invest a little passively before you maybe move into this full time. So Gino, kick us off here.
Bro, that is the best thing that you have said in a long time. You said a lot of great things,
Oh
bro.
boy, I don't know if that's a good thing or not.
let me translate that. What Jake said is you learn while you earn. I mean, what's better than that? You're actually investing money and you're learning the process. A lot of the students who come to Jake and Gino and join the community, they're high net worth earners. They're doctors, they're lawyers. They say to themselves, and they've heard, wow, real estate is an amazing vehicle. And it is. Cash flow, appreciation, tax benefits, cycle resiliency, write all four of those down. That's why we love multifamily. But when you're working 60 or 70 hours a week, it's really hard sometimes to do it full time. Unless you're Jake and Gino, you're a bunch of crazy guys, you're working and you've got two spouses that will support you. It can be very challenging, especially if you're in a high-paced environment. When you're a lawyer or you're a doctor, you have to really focus on your job. To pull that focus away and to start property managing and start dealing with tenants can be very, very challenging. So a lot of the students come on board and they become disheartened. But there are so many other vehicles and so many other avenues for you to start investing in multifamily. And one of them is syndications. Start becoming a passive investor. Start investing as a limited partner. But before you do that, you still need to invest in your education. That's where most people, you fall off and say, I've got a ton of money. I'm going to go invest in a deal. Person with money meets a person with experience. The person with the experience gets the money, and the person with no money gets the experience. What do I mean by that? You still need to know how to vet a deal. You still need to know how to analyze a market. You still need to know how to look at the underwriting. You still need to know about the property management company that they're going to hire, and the financials, and the property due diligence. This is all needs to be learned. So on the front end, you can start learning all of this stuff on your time. Take your time by doing this. Find the community, find educators out there who can teach you this, learn how to vet the deal, and then you learn how to vet the sponsor, and then you'll feel more comfortable. It's almost like, Jake, when you're out there and you're investing in the stock market, most people just want to throw their money in mutual funds. That's low-level financial intelligence. There's a lot of risk there, and anybody can do it, and the returns are minimal. If you want to start learning how to invest in real estate, learn how to actually take one of these deals down. If you were going to do it actively, then find people who are doing it actively and invest alongside them.
Think about what you just said. You said low, I almost think it's like a low-level work ethic because, and it's also, let's be honest, it's conditioning. From day one, you pick up the lunch pail, you're told, go to school, sit there for 8 hours, come home, do your homework, then you're going to graduate, you're going to go to college, and you're going to give us more money, we're going to make interest off of it. Mm-hmm. And then from that point, you go out and you basically do the same thing, but you're going to make money this time. Okay, so now you're in the workforce, you're an employee. And then you put your money in the stock market. Just keep turning it over and be a cog in the wheel. Mm-hmm. So I think the key here is to look at, if you want extraordinary results, you want different results from all the worker bees that are out there. You look, okay, have the people that just invested their money in the stock market had an extraordinary life? Have they had a life of true abundance and time freedom? I think for most folks, the answer is no. So you're subscribing to a pattern, a roadmap that's going to lead to similar results that many other people have got. So if that's what you want, that's fine. But if you're looking for abundance and time freedom, I don't think that's the roadmap that you should follow. The other thing that's key here is we're going to get into the weeds. Okay, we're going to drill deep down. But I want to recap a little bit about what Gino just said. We're going to drill down below the framework. But whether you're investing passively or you're investing actively, okay, still follow the framework. buy right, manage right, and finance right. And we're going to chunk down below that umbrella in a second here, but I think that's the key. It doesn't matter because you know what? You can still vet the people that you're doing the deal with, or you can still vet the deal and make sure those boxes are checked, or you can do it actively yourself. So I think the key is the framework doesn't change, the sponsors may.
I love that, Jake. And the other thing we need to mention is the tax benefits again. Number 3, I said tax benefits. They're huge in multifamily. You don't get tax benefits when you're buying stocks. And the other thing is multifamily is a true asset. As they're printing money and the value of your money is devaluing, the asset itself, as I knocked down, it's a hard asset. It's a basic human need. Food, clothing, and apartments. It is a basic human need. It's not going anywhere. Big Shifts Ahead by Chris Porter. I keep telling my students to read it. Look at the demographic shifts that are going on. RVs are getting to be really popular. Why? Because baby boomers are selling their homes and downsizing. It's becoming a really big space, but people are not buying homes. There's too much student debt, and the baby boomers are downsizing into apartments. It's much more convenient to be transient and give a key over at the end of the year and have that freedom, have that luxury. So there's another basic, amazing benefit that you have in multifamily. So before we dive into those 8 steps, I want everyone to just really think about that. You're investing in an asset, but you're also investing in a basic human need. It's just an amazing tool. And those 4 benefits that I talked about, that's what makes multifamily really, really exciting. Now, Jake and I, we created this 8-step due diligence framework for passive investors. If you want a copy of the download, just email me at gino@jakeandgino.com, and I'll send over this 8-step due diligence framework. Every time you vet a deal as a passive investor, I want you to go through these 8 steps, and we're going to go through them in the podcast right now. The first one is the sponsor. When you're vetting a deal, the most important thing is the sponsor. I'd rather have a great sponsor with a marginal deal than a marginal sponsor with a great deal. First question you need to ask yourself, what is this sponsor's track record? Have they done any deals before? Most important thing, do they say what they do? Now, if you want to sign up with us to become an investor, just go to jakeandgino.com/invest, and you can become an investor with Jake and Gino. But what is our track record? We have over 1,500 units. We've syndicated 3 deals in the last 2 years. We've been able to raise over $10 million for those deals effectively. We've been able to run those deals really effectively. We are very transparent. We're out there. Is the sponsor transparent? Can you look at their success? Can you look at their track record? Can you go online and vet what kind of reviews they're getting? That's the most important thing when you're looking at a deal. Don't worry about the deal yet. Worry about who you're going into partnership with, because as Jake likes to say, once you go into a business partnership, it's like a marriage. You're married to that person until the deal is over.
Gino, it's such a good point because you said just because it's a great deal is the sponsor able to execute. Mm-hmm. And look, this is a full contact sport. Once you buy it, great. You bought it right. Good for you. Did you finance it right? Maybe you did. So maybe you checked 2 of the boxes. But maybe you're very ambitious and you're just trying to grow the portfolio, but you're not tending to your flock. So that's where what Gino said is so important, because you need to make sure that sponsor is going to be there, because look, it's a full contact sport. Sometimes things can get challenging. There's riots going on in the country right now. Is the sponsor going to be able to lean in, take control of management, and push things through when they need to get things done? Because look, it's not it's not just this stagnant, constant, easy peasy thing. Things change. Corona hits. Are they able to manage through Corona? Are they able to manage through the riots? This is the things you need to look for in a sponsor, not just the deal. Because if the sponsor, is MIA when shit's hitting the fan, what do you think is going to happen to your deal? I don't care how good it is. Okay, you need to make sure someone's going to be there and they're going to get their hands dirty.
Jake, I should have said this in the beginning also. If you're a syndicator out there and you're syndicating deals, you can use this 8-step framework to present the deal to a potential limited partner, because you have to think in the limited partner's mind. What do they want out of the deal? What do they want out of you? And these 8 steps, you can create a webinar, you can create a presentation, a PowerPoint based on these 8 steps if you're the syndicator. And like you said, conversely, if you're the limited partner looking to invest in a deal, you need to follow this framework. Ask for a list of their team members. Who's on your team? You have property management. Who is your attorney? Who is your CPA? What property managers do you have on? What property management software are you using? What team members are on that team? It's really important. And
what's your cadence? How are you holding these team members accountable? That's what I want. I want to know what your weekly cadence is.
I love that. And some sponsors may just be starting out and they may be like fumbling. Well, Well, maybe they're not
Gino
prepared
says,
to go to the
ooh,
big
ah,
league.
ee,
Yep. Oh, and what is their investing strategy? Ultimately, just ask the sponsor, do they have a credibility book? Do they have an investing strategy? Are they going into a new niche and they're new going into that new niche? Are they trying a different strategy? They were value add, now they're going into the A space. You have to know what their investing strategy is, and you have to find out if they're qualified to actually take your money, because they're a fiduciary and they're ultimately responsible for your money. So that's really important.
Yeah, I mean, and look at, what's their investing strategy, and do their prior deals align with that, or are they stepping into something new? So I think that's another key. Have they done Class A? Have they done Class C? What are they
Mm-hmm.
getting into now? So that's one way to vet as well. I think it's great.
I love that. The second one is the investor. You have to look within yourself now. I'm going to list out these questions and let you reflect on them. Everybody listen out there. What is your risk tolerance? Do you have the risk tolerance? Do you want just to go into bonds or into stocks and say that's safe? Or do you want to go into multifamily where there may be, like Jake said, maybe issues? We may be having riots. You may be having problems. What is your risk tolerance? The second one,
Can I
where are
touch
your,
on that one for a second,
of
Gino?
course you can.
Because
Sure.
I think risk tolerance should, basically have a home in your personal parameters for investing. So I think one of the things that, investors really should look at is, what are my parameters? What do I buy for a cap rate? What do I
Mm-hmm.
buy for cash on cash returns? What vintage assets am I comfortable with? What is the physical makeup? Okay, so this is what I'm talking about. It doesn't matter how passive or active you are. Everyone should be active to a certain extent and have those parameters set up. So, regardless, even if you're going to passively invest, make sure you're saying, okay, I'm not buying before a certain age because I've seen or I know that there's issues with plumbing. I know that there's issues with certain types of electrical, and list those out. So when a deal's coming across your desk, regardless if you're going to be an LP, you say, okay, this checks the box or this does not. Guess what? You're systematizing your investing, and it makes it a hell of a lot easier. So you know what you're looking for, and when that golden goose comes across your desk, or maybe it's a black swan these days because we don't see so many of them. Whatever, you just know when to pull the trigger because it checks the boxes.
I
So
like that. And, I'm doing reading and I heard this quote. I don't remember where I heard it from, but your education is a change in your behavior. You can read a book, you can consume it. But if you ultimately don't change your behavior, were you really educated? Did you really learn that subject? That's why I'm doing this call, because I want people to be educated on this, on passively investing. Take this framework and utilize it for themselves. And what Jake said there about the investor, about yourself, it's really important to build those parameters. Now, if you don't know what we're talking about, go to jakeandgino.com. Check out a lot of our blogs we've done. Check out our podcasts in the past. We talk about the three-step framework. We talk about the buy right. So if you don't set that up for yourself, you're wasting your time. You need to figure out what your risk tolerance from. The next one, where is your funds coming from? Where is your money coming from? Is it coming from a self-directed IRA? Is it coming from savings? Is it coming from a 1031? Figure out where you can deploy your funds. Really important. The next one, how long is your time horizon? Are you looking to be long-term? Now, Jake and I, we want to create a fund because we want to be able to buy these assets and hold them for the long-term. What are you trying to do out there? Are you trying to velocitize your money, get in, get to 24 months, get out? You need to figure out what your time horizon is. And I'll let Jake share the story with Sam Freshman of why our time horizon has gotten so long. You should go out and check the podcast we did with Sam Freshman on Wheelbarrow Profits. It was an amazing podcast because he's a man in his 80s. He's been syndicating for 50 years. And what was his two mistakes, Jake?
hey, he sold deals. I think was the biggest one, and didn't buy enough, right?
That's right. He
Yeah.
sold his deals. So our time horizon has shifted from a shorter time horizon to forever. Even for syndication, when Jake and I buy our deals internally, we love to hold them because of all the benefits we've mentioned. But our model's changing over to a long-term hold, generational wealth. If that doesn't fit your parameters, hey, then maybe Jake and Gino and you are not a good fit to invest. I'd rather know that on the front end, and you should know that for yourself on the front end.
Let me give the why behind that though. So
Yeah.
fortunately for Gino and myself, we're financially free. We've gone through enough of these deals to say, okay, we know what type of vintage. We have our parameters in place. So we know what type of vintage that we're looking for that's going to be there for the long term in the right markets. We've identified all these things, and we know how hard it is to find the truly great deals. So when we do find them, we want to buy them. We want to continue adding more of them because it's that cost segregation snowball. You use up what you have, you replace with more, and then so we
Hmm.
continue to buy these things, hold them long term, literally pay the debt down, and that's it. We're not looking, to be fixers and flippers because we see the value of the true deal, of a real deal. and we've experienced the amazing cash flow that's created from these, and that's what we really love. And that's just so that's personal parameters. That's what we want. We've seen it, we've tasted it, and we love it, and we want more of it. So
Jake,
it's
transactions
all about eating, right?
pay the bills. Equity makes you rich. We've really
Amen. Say that again, because I was kind of speaking over you there.
No, I'm sorry. Transactions pay the bills, and which is fine. We need to pay the bills. It's nice to get some transactions going, but ultimately, equity will make you rich and will set you free. So that's what we've realized. We want to invest in these long term, and it may take a couple of years for the engine to start going. But once that engine starts going and the snowball starts, you continue to pile on the snowball. I mean, it is an amazing vehicle to get you where you're going. You know,
Yeah,
let me
100%.
ultimately finish up with the investor. What I like to say about the investor piece, the rest of it is look at yourself internally. Are you willing to give the keys over to somebody else? Are you willing to say, okay, I'm going to be passive in this? Because for me in the beginning, it was hard. When I first started out with Jake, I'm going to do this, I'm going to do that. And it was difficult for me to invest passively in some of these deals. But as I grew as a person, learning this framework, and learning how to vet the sponsor, and learning how to become a partner, and learning how to underwrite these deals, it gave me more confidence to become a passive investor. So look internally, see if you are the type that will able to do that. Because if you can't do that, it's going to become really difficult to become a passive investor.
Yep, all about the framework, man. It just keeps coming back to it. Nail the buy right, manage right, finance right, for sure.
So we've got the sponsor, number one, the investor, number two. Number three is the market. Where are you investing, or where is a sponsor investing? What market is he investing in? This is truly important because when you buy the deal, it's about location. Multifamily is about jobs, 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 and population growth. You want jobs and population migrating to the city where you're investing in because that's where your demand is for your product. If people are fleeing a market, what's going to happen? The supply demand curve is the equilibrium is going to be off. There's going to be more supply, less demand. Rents are going to drop. You want rents at least stabilizing or at least rising in your market. And that happens when jobs migrate and population migrates. So,
Gino, such a good point, because here's the deal. Inflation is going to come. Costs are going to rise. Expenses are going to go up. And if you don't have the demand to keep up with that, that's one of the number one reasons we love this. Because we're able to keep up with inflation because we're picking markets that are growing. If you get a dud market that's flat or declining, expenses are going up, and you're not able to keep up with that, that is a recipe for disaster.
Yep, I agree. So in the sheet, I've got a bunch of different metrics for the market, whether it's unemployment, employers in the market. We're talking about occupancy, rent growth. Go in that document and take a look and make sure once you're analyzing whether you're in Knoxville, Tennessee, whether you're in Asheville, North Carolina, wherever that is, get the metrics out and make sure that it's a healthy market for you to invest in. Because once you're in there for the long term. The number four is the deal underwriting. There's several questions in here that are really important when you're underwriting the deal. First thing is, what's the projected internal rate of return? What are they projecting to make on your money? The next one, is there a preferred return? Are they giving you a preferred return on the deal, or is it being pushed back? The next one, what is the GP? General partner promote. What are the splits on there? Really important, those three. And I'll hit the fourth one before Jake comments on it. What are the fees involved? Acquisition fee, asset management fee. Is there a disposition fee? Is there a refinance fee? Is there a construction management fee? There's a lot of fees involved when you're going into a syndication. Just be clear on the front end what it's going to cost you. But ultimately, you want to see the projections of the deal. You want them to be conservative, right? Because what's happening with COVID right now, as you can see, everyone was projecting 5-6% rent growth, and all of a sudden, I don't know if we're going to have any rent growth this year. So you want a conservative underwriting, and you want to be able to understand the underwriting that they present to you.
Right on. Hey, gang, let's take a quick time out to hear from our sponsor, and we will get back to the number one key in real estate.
At Rand Capital, we're focused on providing the best financing option for each deal and every client. Our personalized service, along with our blue-collar work ethic, will give you the peace of mind to know that we will take the stress out of the financing process so that you can focus on other aspects of your business. For more information and to find out how Rand Capital can help you find the best loan for your deal, visit randcapllc.com to start the conversation.
All right, G-Daddy, we are back. And, drum roll, the number one key in real estate is that everything is negotiable. So, I don't care if it's a bank. I don't care if it's a seller. I don't care if it's a GP. everything is negotiable. So here's the deal. They may not negotiate with you, but it never hurts to ask. Okay. And I've been, the times where I don't ask are the times that I get burned and I'm calling Gino up and saying I screwed up, pal. So look, if it's acquisition fee, asset management fee, disposition, construction management, refinance, listen, everything to a certain extent in real estate is negotiable. Never forget that. And look, it can be pesky, it can be annoying, but look, that's at the end of the day, $50,000 off here, can make a really big difference. And if you do that enough times, you put together $250,000. So I think it's always key to keep that negotiation mindset in place. And look, if it comes to fees, if it comes to any of this stuff, just know that you have the power, as He-Man said.
I love that. So everyone, go to jakeandgino.com. Type in Chris Voss. We've done a couple of podcasts with Chris Voss.
Yeah.
Listen to those podcasts with Chris Voss because he'll talk about tactile empathy. He'll talk about accusation audit. He'll talk about mirroring and really what can we do to get the deal done? What can we do for me to invest in this deal? So it's all about negotiation. You can negotiate anything in life, and his tactics, his tips that he has in those podcasts are gold. So like Jake said, everything is negotiable. Love that tip, Mr. Stenziano.
So I don't even know if I told you this or not yet. I'm just gonna drop it right here because we're getting personal now. So the G-Dad's coming to town for a week, and my wife has been hitting me up. She really wants to get a pontoon boat, and I'm like, I'm not getting a freaking pontoon boat. But then, so I think I coupled the G-Dad's coming to town with the pontoon boat. I finally broke down, and I did it the other day. So I'm posting that out there. But the key to it is we were, I ended up getting a little over 10% off after I got two initial discounts. Okay, so I got a 2019. There was two initial discounts. One was the normal discount they were trying to get me in, by. The next one was there's a 2019 discount. So it's feeling pretty sweet. And the deal was that it was the champagne color. So they didn't, they're like, we're not moving it. Everyone, the blue and the black is selling really hot this year, whatever. So I sent him a Chris Voss email, and I got an additional $4,500 off. So, I did pretty sweet. And it was funny because I was sitting there signing the papers the other day, and he wasn't going to gas it up for me. And I go, what? You're not going to send me up? I want the complete package here. And he goes, you're killing me with this thing. You've already hit me so many ways. So, but the key to it was, and this is my favorite thing from Chris Voss, was I basically teed it up like this. Hey, I can come in tomorrow, pay cash with a quick close. Are we able to get to this price? So it was not like I'm going to beat you up, I'm going to punch you in the face. It was, here's the value that I'm going to bring to you, okay? How are we going to get there together? He didn't even say anything back. He just folded, gave it to me, and it was done. So look, it's not always going to go that easy, but proper preparation, to Gino's point, prevents piss poor performance. So I came prepared, knowing those levers, hit them with one email, one turn close, like that. But I got to, maybe he's beating me up on the gas. We'll see what happens.
I love that, Jake, but there's another thing. Go to jakeandgino.com, type in Orinclaff, pitch anything. Because right there, Jake was not scarce. He was not needy. He didn't show his hand saying, I need this. Hey, if the deal's there at this price, I'm not going to waste your time. Let's get together. If we can do it, great. If not, I'm walking away. And, right now, they need to sell the boats. They need to get rid of their product. So, excellent way. Hey, dude. I can't wait to get out there.
We got some sunset cruises coming up with this family, man. It's gonna be good. So
it's funny. Jake's blaming me now. He's like, dude, you're killing me. You're coming down here. I had to buy the boat.
I'm not gonna. You know me. I like whenever I can negotiate a good deal. It always gets my juices flowing. So I had fun.
I love that. So let me recap everybody. Sponsor number 1, investor number 2, market number 3. Dealer underwriting was the 4th one. The 5th one is property due diligence. Now, Jake has really stepped it up with the property due diligence. When we first started investing, we got an inspector out there. Jake went out there with the inspector, and we looked at the properties, took some pictures, and negotiated that way. Now we've brought it up to another level. We have our CapEx crew out there. We are scoping the lines with the plumbing. We're looking at all the HVACs internally. We're looking at foundations really well.
It's a small army that gets dispersed, and everyone's looking at every nook and cranny now. So
it looks amazing, right?
Yeah.
So was there an inspection done on the property? As the LP, you need to ask that. Can I see it? When was the property built? When were the roofs replaced? It's so many different things. How old are the mechanicals? There's a list in here that you can actually ask as an LP. And if the sponsor can't answer these questions, then he's not a great sponsor because he should be doing his due diligence on these properties. So
but that's why even if you're going to be an LP, you have your parameters. And if the sponsor's not able to produce those, on to the next one.
That's right. So how does it compare with the comparable assets in the market in terms of rent per square foot, amenities? They should say, hey, this property has a pool. Everyone else has a pool. You know, the unit mixes are not so great. I've got a lot of one beds and some two beds. They need to know all those answers. So it's in the sheet. The next one, I think, is one of Jake's favorite. You know, this is why I think we're truly successful. We're vertically integrated. The property management. Who is property management? Not asset management. Asset managing is different than property managing. Asset managing is the asset manager or the syndicator who's managing the property management company. This is third-party property management, or as we like to say, RAM property management. We're managing our own assets. I'd rather go with a sponsor who's managing their own assets only because they have more control. I mean, that may be short-sighted, but I like to see people buying deals that manage their own assets, because this is where the manage right portion, like Jake says, the second part of the framework, that's where a lot of people stumble. That's not where they're executing.
It's not sexy, it's not fun, and it's not easy. But I'm telling you, this is your moneymaker right here.
Yep. And you know, there are a lot of great third-party property management companies out there. There are, but questions: are you going to manage the current property, or are you replacing it? Is the current property management company that's in this deal, are they staying there, or are they being replaced? How many units does that management company manage? Really important. If they're only managing 50 units and they've got a 100-unit property, I don't think that's a great fit. What type of software do they use? Do they have property management software that's in the cloud, right? What type of insurance do they carry, right? Do they have experience in managing this type of asset? All these questions, they're in the sheet. I don't want to go over them because there's a bunch of them, but you get the idea. You have to vet the third-party property management or the property management company that is running the deal. Crucial. That was number 6. Number 7.
Framework, baby. Keeps coming back to the framework.
I mean, Jake,
right?
you can talk about it a little bit because you run the property management company, and what should they be looking at as far as property management companies? What is the glaring omissions that you see with property management companies?
So it's the same type of stuff. Here's the other thing too. There's companies that are just known to suck. Because we look at deals and there's like specific companies in the markets that we're in that we're like, oh, and then you'll get this from the brokers, and they'll give you a little bit, that's an opportunity, right? So I think it's important to know the market that you're in and who's respected and known to be a good operator. That's like one of the most important things. But then also like start to look at, we have a CapEx crew. Is there a renovations team that is associated with that? Because that's gonna reduce your fees. You know, let's understand the systems. Let's understand the types of deals that this company manages. Mm-hmm. That's very important, because if the history is managing A+ properties and you send us into a C neighborhood, look, that there's inherent risk there, because that's not your bread and butter. Have you done HUD? Look, we have a small HUD property, and it is the bane of our existence. Look, we're vertically integrated. It's something that Gino and I own. If that wasn't but that's the thing. So you want to make sure that it's all tools in the tool belt, right? You know, we talk about financing, and we're going to get to that in a minute, but you want to be able to use different tools. And that's why we love Rent Cap and using a mortgage broker, because that broker is going to be able to look at the deal and identify the best tool for that project. And it's the same thing with property management.
RandCapLLC.com. Go check them out because it's a great resource. What I would say to this is Jake being sneaky. This is what you could do when you are an LP and you're investing in a market. You call up a couple of real estate brokers and you ask them, what about the ABC Property Management Company? Are they a good property management company? Yeah, they're good. Then you would, the second question you ask, which is really important, what property management company would you stay away from? If you get the same name from a few different brokers, that's a tip.
And you will.
Yes, you will. So there's a couple that are notoriously bad. If the syndicator or this company deal is using that property management company, there's a red flag right there. So that's something that's really important. Pick up the phone and call a broker. Spend an hour vetting the property management company on the front end. It's going to save you a ton of time, because they are the face of the organization. When a resident walks into the office, the property management company is the first thing they see in the first interaction they have. And on the property, is the property being maintained? Is there a lot of deferred maintenance? Those visuals, when you first see it, are truly important. The property management company needs to have systems. So if you're getting bad vibes, you're not getting great recommendations, maybe this is a property that you should pass on.
And it doesn't take long.
No.
I mean, you're walking a deal with a property manager, you're going to know in that first hour.
Yep. And really Google, I mean, you're going to have Google reviews. A lot of the reviews are going to be negative because just people like to complain, but there's a trend. If you start seeing, rodents, if you start seeing management, maintenance is not taking care, pick up the phone and call them and call their competition and see what's going on. That's really important. Number 7 is the financing. What kind of debt are they using on this property? Is it assumable? What's the loan to value? What's the DCR, debt coverage ratio? How long is their interest only? all these questions are on the financing. I don't want to jump into all of them, but you need to understand as the LP what we talk about in Jake and Gino, the 3 pillars of real estate. What market cycle are we in? What is the debt component? What are they using for debt? And what is the exit strategy? So you really need to know what kind of financing they're using. And is it smart, the financing they're using? Are they using bridge? Are they going to be refining this property? Find out what type of financing they're utilizing on this deal.
Yeah, and we have plenty of resources within the community to handle all that as well.
Mm-hmm. And the last one is legal. Really important. Who is preparing these syndication documents? When are distributions being paid? How are you going to collect my funds? What, are you going to do ACH? Is it a secure payment? Because right now, cyber is really up right now as far as people transferring money and losing money.
What are you talking about, Space Force?
Right now, there's a lot of issues out there where people are sending in funds and they're being stolen. So how are you collecting my funds? And also, is this deal open to accredited investors or sophisticated investors? Is it a 506B or 506C? Really important to understand that component of it. You want to add anything else to the legal, Jake?
Get with your insurance company. Make sure you have some cyber insurance. And make sure you understand what it covers. I think that's always an important thing as well, because it can help with some of these things.
So let me just really quickly recap it. The sponsor's the first one. The investors, the second one. Yourself. Number 3 is the market. Number 4 is deal underwriting. Number 5 is the property due diligence. Number 6 is the property management. Number 7 is the financing. And number 8 is legal. So as you can see, it's a holistic approach. If you're a passive investor and you use these 8 steps, you're going to get a really good idea of how this deal looks, how the sponsor looks, if it fits your parameters, if it fits your investing style, and if you want to place capital with that company. So it's really important. If you want to copy this, like I said, email me at gino@jakeandgino.com and I'll send the copy over to you.
Lean in, baby. Well done, G Daddy. I love it.
Senzi, anything else going on we can share with the listeners as far as collections going on, as far as our property management, as far as the asset class in general? I feel positive. I think we're getting out of Corona right now. I think things are starting to escalate and elevate a little bit better. I think once evictions start really to happen, I think people are going to take control. I really think the unemployment money and the money coming in really helped stabilize everything as far as our asset class. So, you want to share anything else with the listeners?
Yeah. So, not to oversimplify it, but my brain works in systems. I like systems. I like having frameworks for things. So, if you want to chunk it all down, it always comes back to it. If you want to be in this space, whether actively or passively, education times action will get you your results. That is the overarching, success formula to get into multifamily. Get educated, take action, whether it's actively or passively. That's where your results come from. From that point, it's people, systems, and culture. It's a business, and you need to work on your systems. And that's what this all comes back to, folks. Buy right, manage right, and finance right. Have the parameters listed underneath each one, and follow the framework. And it becomes a duplicatable process. Mm-hmm. Stay in your lane. And I know for the longtime listeners, you guys have heard of us preach this for years, and it sounds like a broken record. But that's what it comes down to. Gino, I own 0 Bitcoin. The only other thing I want to own besides apartment, maybe a couple of gold coins, maybe a little silver here, maybe got some brass in the closet. You know what I'm talking about? So it's those type of things. Stay in the lane, focus what you're good at, and continue to duplicate that. So
I'm gonna end off by saying it's really important. We didn't mention this, but we should have started this from the very beginning. Your sponsor and the property management company and yourself, we should all have core values. What are their core values and what are their mission statements?
The systems piece.
And they should really realign with what you're doing,
Culture.
right? And it's the vendors when you're dealing with vendors, so you really have to focus on that. And ultimately, your behaviors are belief driven. If you believe that you can invest in this asset, if you believe that you can learn this stuff that we're presenting today, you're going to be successful. But you need to take the education. You need to take that action. And like I said, your behaviors, what you're going to do, how you're going to execute, are belief driven. If you believe you can do it, then you can go out there and you can freaking make it happen.
Gino, this was so good. There was so much value brought on this podcast. I don't know if we can let guests back any longer. I don't know if guests are going to be allowed anymore. This was too good. I'm just saying, man.
This is the best part of our day, right? This is what partnerships are all about, everybody. If you can't, I call it the Gino sniff test. If you can't sit with your partner and have a beer with your partner and hang out on a pontoon boat, then you should not get married to that partner. Maybe a one-off deal, but you ultimately have to have the long game. Multifamily and LP investing as a passive investor is a long game. So you have to I'm going to say this again, you have to vet the sponsor because you're going to be with that person for a long time. So if you get the heebie-jeebies or you're not feeling great about that person, you're going to be with that person for a while. I don't care.
Life's better to cut ties. It's okay.
Yes. I don't care if the guy's going to give you, or the lady's going to give you 25% on their, I don't care about that because ultimately I want transparency. I want honesty. I want to work with somebody who puts people first. That's what our core value is. People first and extreme ownership. Make it happen. So, Stenzi, we'll think about guests going forward. So I appreciate the time. And everybody out there, if you have any questions, just email me at Gino@jakeandgino.com. Until next time, we'll see everybody. Thanks.
That's fun. Thanks, Gina.